If you're watching this today, you might be interested in making contributions to your super fund. This can be a very good strategy because it's a great tax-effective environment and a way of increasing your retirement savings. In July 2021, the government made some changes to the amount of contributions that you can make each year. First of all, we'll talk a little bit about concessional contributions. Concessional contributions are any employer contributions, salary sacrifice, or personal concessional amounts that you choose to make to your superannuation fund. Now, remembering that this year, employer contributions are 10% as a mandated amount that must be made on your behalf up to certain limits. So the limit now is $27,500 in total that you can make between your employer contributions and your salary sacrifice or personal concessional amounts. One benefit of concessional contributions, such as salary sacrifice, are that you can make these payments from your pre-tax earnings. So, for example, if you're in the 47% or the highest marginal tax bracket, you can elect to contribute money to your superannuation under the concessional contribution cap and bear no tax on this money. Bearing in mind that when the contribution goes into the fund, you pay 15% inside your super fund, but that's still a large saving. Next, we'll talk about non-concessional contributions, and these are sometimes known as after-tax amounts. So, where you might sell a business or some assets personally and perhaps are getting ready to move into your retirement years and have large amounts of capital to contribute, you can make use of the after-tax contributions caps, which are currently $110,000 per annum, or for anybody under age 65, $330,000 by bringing forward 2 years of future contributions. And this can be a great way of topping up that super fund and giving you some much needed money for your retirement funding years. With non-concessional contributions, there's no tax that's leveraged on the way into the superannuation environment, but you get no personal tax concessions. There are a couple of little known superannuation contributions that can be made that can also give some really good tax advantages. One of these is called a spouse contribution and is particularly useful for my clients that have one income earner that might be earning a lower sum than the other. So a spouse contribution enables the higher income earner to put $3,000 up to $3,000 into the eligible spouse's super fund and gain up to a $540 tax offset. This is a great advantage because you get the benefit of $3,000 extra dollars in the lower income earners fund and $540 back in your pocket at tax time. Bearing in mind that the eligibility for this is that the receiving spouse must have income of under $37,000, and that amount does taper off until the maximum limit is reached of $40,000 per annum. And finally, the government co-contribution. This one has been around for a number of years and has had some changes over time. So the current legislation says that if you're earning up to $46,112 per annum, you can contribute up to $1,000 into your super fund and the government will pay $500 into your super fund. There is an upper threshold on this of $56,112. So if you go over this amount, the government will not pay anything on your behalf. There's also a couple of extra eligibility criteria in that your superannuation balance must be under the upper total super balance cap of $1.7 million, and you must also have eligible income of at least 10% from an employment or business situation.